Subscribe to our YouTube channel and press the bell icon to get the latest updates.
The rating for the air quality index in Delhi has deteriorated from very poor to severe. You don't have to be an environmentalist to understand how dangerous that is to the lives of Delhiites. Mumbai and other Indian metros are not significantly better. Wish there was such a rating system for the pollution levels in financial markets too. One that could tell you how poisonous the financial market assets are without having to decipher the financial mumbo-jumbo that TV talking heads throw at you. The plain fact is that the pollution in the financial markets today is higher than it was a decade back. Yes, the debt levels are lower and banks are better capitalized today to lend. But that does not reduce the risk of losing money in fancy businesses with little or no visibility of profits. Falling prey to false narratives, you are more likely to inhale poisonous stocks in your portfolio than you would otherwise. And the worst problem is that the smog has left you helpless. There is no visibility. Seeing others make big money from speculative bets is one of the most dangerous aspects of this killer smog in the financial markets. And every time investors, both novice and seasoned, keep falling prey to it. This is not to say that I paint all stocks with the same brush. There are certainly pockets of oxygen in the smog, and the diligent research process could certainly get you great buys even amongst the riskier variety of stocks. But the problem with the smog in the financial markets is that most investors get carried away with the prospect of huge gains in newly listed, high-growth, mid and small caps. They see no reason to hedge their risk by being extremely selective in buying stocks showing exponential growth. The memories of the past have already faded, and most investors have forgotten that the last time markets crashed, stocks with fancy and false narratives like Reliance Power, Vakrangi, 1% beverages destroyed massive shareholder wealth. Even now, the stock of Paytm, featuring amongst the worst performing IPOs globally, has not dimmed speculative interest. I asked the members of my Telegram channel in a recent poll about the asset class they would choose to have the maximum allocation in 2023. And like you can see in the chart here, high growth mid-cap and small-cap stocks were the outright winners. So I believe the secret to maneuvering the stock markets safely and profitably in 2023 will be about being selective and disciplined. Not giving into the greed of buying the IPO favorites or the hottest small caps could do a lot of good. Resisting the temptation to get onto speculative trends could save you from Paytm-like disasters. Now, no denying that few pockets of high-quality mid and small-cap stocks could be wealth-creating juggernauts over the next decade. But the hunt for such stocks can be time-consuming and tedious. A good screener for such high-potential small-cap stocks could come to your rescue. I have given a link to one such screener in the description below. But what you really need to focus on is the cyclicality of small-cap valuations. As is evident from the small cap to Sensex chart like you can see here, loading up on small caps works best when the ratio is well below the long-term average. Buying small cap stocks indiscriminately when the ratio is in excess of 0.45 times, as is the case today, can prove to be extremely harmful. Now, this is not to say that small cap multiples could crash soon, as was the case in the previous small cap upcycle between 2015 and 2018, several high-risk small caps could continue to fetch lofty valuations. It is not just the small cap to Sensex ratio that can stay overheated for long. One of the most popular valuation metrics in the United States, the CAPE, cyclically adjusted PE ratio, has been above its historic average for 95% of the time over the last 30 years. Just because something is above average does not mean it is going to revert to average anytime soon. But the cornerstone of good investing strategy is ensuring that you take care of the downside. The upside takes care of itself. Legendary investor Joel Greenberg articulated the secret of his investing success as, "My largest positions are not the ones I think I'm going to make the most money from. My largest positions are the ones I don't think I'm going to lose money in." It's far easier for a business with solid cash flows, healthy balance sheet, big franchise, best brands, and loyal customer base to survive a crisis. The core business remains stable despite months of slowdown, pricing pressure, and intense competition. And despite limited future visibility, one is reasonably assured of fetching risk adjusted returns. So, by all means, buy mid cap and small cap stocks in 2023, but be selective and patient about their quality and valuations. When it comes to small caps, look for the magic ratio of 0.45x or below in the small cap to Sensex ratio. And when the market valuations seem to suggest that the ratio is comfortably lower than 0.45x, you know you're good to go to act on your small cap watch list. Do this and you will find yourself holding some amazing stocks that can go on to become some of the biggest and best blue chips in a decade. Hope you find this indicator useful. Do share which other kinds of fundamental indicators would you like to understand about in 2023 in the comments below. Thanks for watching.